We have a full day planned with some great speakers. We have a dinner party later on today. But we're going to start with Axel Merk. I've known for many years. I don't know. I think it's more than 10 years now. So Axel is probably one of the largest fiscal gold managers in the United States. Is that accurate? Or if it represents a family office of considerable means, and they've been investing in all kinds of things recently. We don't like glad handlers to talk about economic outlook. I think Axel is going to be very real in what he talks about. So I'm going to let Axel take over. Axel, want to come on up, and you can sit in the seat where Eric is, and then we'll just let you go.
Great. Good morning, everyone. Thank you for the kind introduction, Marty. Yes, as Marty points out, I'm a portfolio manager. I'm a chief investment officer. I'm a family office manager. Some people say I'm an economist, but let me just say the reason why economists might be interested in the second decimal point of the GDP forecast. That's not me. So if that's what you're looking for, then come back for dinner or for later presentations. The reason why I believe an outlook on the economy is relevant, and that's the context in which I talk about it, is in terms of risk management. And risk management for investors. I mean, family offices are investors. And historically speaking, risk assets, equities notably, perform better during economic expansions. And so that's why we want to know what might happen to the economy. And then, of course, secondly, more specifically, in a recession, access to credit is tighter. So if one specifically looks to finance a project or wants to have low interest rates potentially, it's obviously of relevance where interest rates might be and how easy access to credit might be. So it's in that context. And then to be more specific, I do think that's relevant. There's this big debate, and I'll touch on that, on whether it's going to be a soft landing or more severe landing. Well, the relevance is not just that it's nice to talk about it, but in a soft landing scenario, because risk assets have a discounting mechanism, it kind of glances through that. So equity markets can perform reasonably well. When you have a more severe recession, then corporate earnings slump and the market gets all glass half empty, and the bear markets tend to be associated more with more significant recessions. And so it's in that context. And then, as I mentioned in the outset, I do think it's a risk assessment. Right? People often ask me, how much money should I put in this or that? Well, it's a question of how much money can you afford to put in something. Just a little background on me, we manage over $1 billion in gold and gold mining related investments. And I usually say, you got to be able to put your investment under your pillow. You got to be able to sleep with it at night. And I don't mean actually the physical gold bar under your pillow. But what I mean is that if you get sleepless nights, then you're overexposed. So that's I think the more scientific way of approaching whether you have an adequate asset allocation. And obviously in a tighter interest rate environment, people, the retail investors bails out, the sophisticated investor does risk management. Well, it's the same thing, right? You de-lever. And that's kind of the whole point of raising rates. So with that background, I'll touch on various things. My main goal is to get your thinking about certain scenarios. And so I trust many of you follow the news. So I'm not going to try to be too repetitive about what you hear. But I will say that, of course, the Fed has been trying to be, quote unquote, higher for longer. Well, what does that even mean? To me, higher for longer is not a strategy. It's a tactic. It's a tactic, and that makes a difference, because it would be very helpful if the Federal Reserve had a strategy. If the Federal Reserve had a strategy, you can plan for it. Whereas the Federal Reserve has gotten into micromanagement of the economy. And they, a while ago, said, we're not going to give a forecast anymore. Every meeting is a live meeting and whatnot. Well, that's BS, because the moment they say, we have to look at the next phase, we have to start thinking about lowering rates, of course, the market is going to take that leap ahead and is going to discount that. And the Federal Reserve, the whole point of raising rates is to break things. Now, that's not Fed speak. But that's what tighter financial conditions do. You want to slow down the economy, you want to get inflation down, and that means you want to break things. And so if you're now going to say, hey, I'm done hiking rates, and I'm going to lower rates now, well, financial conditions are going to ease, and then they might have to hike rates further. So the talk is certainly going to be there. And one simple old adage is, well, you don't fight the Fed, and that's probably the easiest way to think about it. But the side effect of the Federal Reserve not having a strategy is that there's going to be more volatility as the Federal Reserve, as the market is trying to interpret every word that Mr. Powell says. The market's going to jump up and down and whatnot. Ultimately, if the economy holds on, they'll keep interest rates tight. If the economy falls apart, they'll lower rates. It's really, they're going to be driven by the market. But because they don't publish what economists call the reaction function, because they don't have one, they will just induce more volatility. And you got to see that in the context of two things. Ben Bernanke, he wrote a book that he published towards the tail end of the pandemic. And he then rewrote some chapters because some of the inflation was high and he had not accounted for that. But he made some fair points on that. And one of them is that once inflation is high, the process is not linear. So by all means, with quote unquote tight financial conditions, inflation is gradually going to come down, but it's not a linear process. So it's going to be jumping. And if you then pair that with a Federal Reserve that doesn't have a clear-cut strategy, that just adds to the volatility, adds to the issues that there might be. And so you as an investor might want to have your own idea of what's going to happen. And so the Federal Reserve will want to lower rate eventually, but they would like to have a soft landing. Well, wouldn't we all want to have a soft landing? It doesn't mean they're going to get it. And so my argument is that it's almost impossible to get a soft landing. And if you think about how the Federal Reserve functions, it's a debating club. And debating clubs are not known to make fast decisions. And we saw that really unforgivable thing of hiking rates too late. And it's because they couldn't agree. And by the way, the only retrospection we've had is that, oh, everybody else also put it wrong, and then it's really not our problem. Well, it is a serious problem, and unfortunately, none of the major central banks have addressed that and really looked into how to fix that fundamental issue. But ultimately, they have the bazooka, so it doesn't matter whether we complain, we have to deal with it. Now, think about the tail end. Well, the Federal Reserve is haunted by the stagflation of the 1970s. 1970s, they lowered rates too quickly when the economy came down, inflation had another burst, and there was all this nightmare that then followed for the Federal Reserve until Paul Volcker raised rates quite dramatically. And just as a reminder, when Volcker beat inflation, he didn't get inflation down to 2%. He got it down to 4-ish, and then it took several years to come down further. And of course, the Federal Reserve is not going to say we only want the inflation down to 4% because that creates another host of issues. But still, the mindset is, oh my God, we don't want to be early in lowering rates. So unlike in a previous economic cycle, they're not going to lower rates at the first hint that the economy is getting weaker. Instead, they're going to be doing late. Now, inflation is the boogeyman. Well, inflation is one of the most lagging indicators in an economic cycle. So we know that inflation, everything I say here is hypothetical and risk and disclaimers and not investment advice. So with that out of the way, odds are that as the economy is slowing down, inflation will be coming down more slowly. And then the other thing we know is that monetary policy acts with a lag. So you tell me we have tight financial conditions. We know that the Fed is almost certainly going to be late. That means that tightness is going to ripple through the economy for a while after even the Federal Reserve starts easing. Now, mind you, if something dramatic happens, they can of course always take out the fire hose. And if something more serious breaks, that the Federal Reserve doesn't break. But in this context, I just don't see how it is possible to have a soft landing. Now, of course it is possible, but it is not my baseline. And again, right, I think nobody has a crystal ball. And if you look at anybody making a forecast, almost all the time,
What
it's
does
wrong.
that mean as to the timing?
There's a question, what's the question, Alan? Alan Snyder, you got a question about the
agree.
timing?
But when does that mean you'll have it together? Sooner the better. That was it was originally, wait a minute,
Alan, are you asking a question?
it's September 27th.
Oh, I think it might not be a question. Keep on going.
Good. So maybe for the YouTube. Anyway, so of course it's in the context of a resilient consumer. Part of the reason is well known. Many people have locked in lower mortgage rates. Also, I think that's a little underappreciated. A lot of the pandemic relief was still playing out. The student loan repayments are only starting, but we've started to see some cracks in some parts. Very much on the margin, nothing too serious. Context is, of course, 2/3 of the economy is the consumer, so the consumer ultimately matters a lot. And so the Federal Reserve will be simply higher for longer. Let me expand here a little bit and mention a couple of other areas, some of which I think are not mentioned often enough. Before we started here, I think the topic Silicon Valley Bank came up in a little side conversation. Some of you may recall we had a little banking crisis earlier this year. Some of you recall there's no banking crisis. Well, is there really no banking crisis? The Federal Reserve took out its bazooka and converted an acute problem into a chronic problem. And by giving liquidity on assets that are underwater. Small banks in particular have been so busy with addressing red tape, with all the wonderful bureaucracy that's been thrown at them, that they forgot to manage their core business, notably interest rate risk. And I phrase it this way because I do think regulators have a contribution to that. Margins are tight, and so you only have so much resources. You want to comply with the rules, and then you forget the big picture, right? That does happen. Obviously, Silicon Valley Bank was an extreme case on that, but there are many banks that have managed interest rate risk. Now, the Federal Reserve has thrown them a lifeline so that they don't have to realize the losses. The FDIC has overstepped its authority by providing implicit assurances. So I don't think the banking system will quote unquote blow up. But what happens when your bank and your balance sheet is impaired? Think about Japan in the 90s. You're going to be less inclined to lend. The other aspect to that is commercial real estate. Now, a lot of small banks have substantial exposure to commercial real estate. The loan to value ratios in commercial real estate in small banks are very acceptable. So even taking a haircut, they will probably not quote unquote blow up their balance sheets. But again, resolving commercial real estate takes many, many years. And obviously from the owner's point of view, they rather hand over the key when the economics don't make sense anymore. And so if you're in the position of a small bank, yeah, you'll survive, but you're not going to be very eager to extend credit. Now, the question is, what's the impact on the economy? In my view, small and medium businesses get a lot of credit from small banks. Big banks are not well equipped to serve small banks. And so I think there will be a significant headwind. Now, many of you probably heard that numerous private credit funds are ramping up and will step in. And I do think they will step in. At the same time, I do think it will take them a while, if not years, to fill that void. In the meantime, I think the small banking issue is an issue that's not so different from the savings loan crisis in the early 80s. It will take many, many years to solve. And the reason it takes many years to solve, because politically, it's just not attractive to shut down all these small banks. And so they will be getting lifeline after lifeline. In the meantime, they'll be dragging on until some of them will have bigger issues. And once in a while, we'll have a bigger bank or bigger of these small banks have an issue, and it will get the headlines. But it is a headwind to economic growth that I think that is being underestimated. The other stimulus that's working against the Federal Reserve is the Alto. We had an Inflation Reduction Act. We've had dramatic incentives to invest in certain industries. And that is an economic stimulus. Now, at the same time, the same administration has thrown in more red tape. So strategic minerals are where we should invest in, according to the government, and where they want us to invest in. At the same time, the government has put in place more red tape for some of those things. So it's shockingly, the current administration, like any administration, is interested more in votes than reasonable policy. But what that means is when you throw a lot of money at a problem, that's also somewhat inflationary, because things will go into a specific area. Also, we've historically accused China of pursuing industrial policy. We have that more and more in the Western world as well, including the US. It mostly means a less efficient capital allocation, which means less growth and more inflation. Indeed, the policies that are in place, and let me bridge to that here to the next topic on the geopolitical landscape, are sucking out investments from other parts of the world. If you want to sell certain goods in the US, you got to produce it in the US. And so investment projects now need to be created in the US. That's good for the US economy. It's not so good for the European Union. It's not so good for China. Indeed, in the European Union, because they were worried about industrial policy favoring certain businesses, they made them illegal. The idea was that, oh, Germany can't do a subsidy that Spain doesn't do, and so forth. They didn't really plan that the US would do that sort of thing. But the short of that is that we will see more tit for tat as bigger countries are fed up with these sort of policies and see these things as a competitive threat. Also, on that note, we've had obviously this theme of deglobalization. Again, that increases the cost of business. That does cause those inflation. Yeah, go ahead, Marty.
So before we jump into geopolitical, which I think is super important, right? I mean, obviously the stuff that's going on with France right now, it really threatens it, right? But before we get there, I just wanted to bring up a point. You were talking about like 1980s and all about real estate versus today, commercial real estate. But isn't the issue that we have today is that the way to look at the economy is going to be vintages. So there's going to be this easy money vintage, and all of these loans that are like stuck. Like you mentioned that, you know, most Americans have very low mortgage rates, right? So I think that the number is that something like less than 5% of Americans who have mortgages have floating mortgage rates, whereas like in England it's 25%, right? But so if you're in and you already have your rate done, you're in great shape. But if you want to get a new mortgage, that vintage is going to be pretty bad performing against you, right? So if you look at the 1980s, they had the ability to cut rates, right? That was the solution to everything. Every time we had an issue, a problem in the economy, they cut rates. But that's not happening anymore, right? These new vintages are just going to be increased rates for anybody. So it's going to be, how can you survive? Your portfolio of business is done at 2% rates, and now you're going to have a portfolio done at 9% rates. And it's kind of like, you know, how do you survive in that environment, right? So can you talk a little bit about like what that means economically for people to step into this high rate environment if they can get financing at all?
Well, obviously, I mean, what it means is that the volume has dried up completely in most of these transactions, right? That's and prices have got stuck there because so little supply gets on the market. The prices have been holding up in some places. We outside of our business on the private side bought a multifamily home in San Francisco, and again, not investment advice. My wife did the numbers and said the numbers are great, because I mean you have forced sellers, right? It's a little different market in commercial real estate, but you have investment funds that got levered, that refinance comes due, their math doesn't make sense anymore, and they dump these properties on the markets cheap. At the same time, it's very few of these properties, so that will be an ongoing issue. Mortgages are obviously longer term, and since I'm talking about the economic outlook kind of for next year, I didn't touch too much on these mortgage rates because not too many of them will be resetting next year. Now that will happen, of course, over time. Now let me touch on one thing. What would get mortgage rates to come down? Mortgage rates to come down would obviously suggest that the Federal Reserve is cutting rates. And with what I've said earlier, we need to have a pretty severe downturn for the Federal Reserve to do a U-turn and to lower rates. Now, of course, on the margin, rates coming down a little bit might start getting the wheels, so to speak, grease, meaning more residential homes will get on the market and so forth. And the question is, well, what will happen, right? Is the lower rates, are they going to support the prices, or as people finally starting to move, is that going to get prices lower? My own view on that is that it will be geographically dispersed, so people will move to places that are economically doing well, and out of those poor areas, and so we're going to have a greater dispersion of prices. And in that sense, in many ways, Silicon Valley has had its recession already, and I'll touch on AI here in a bit, but Silicon Valley has always been boom and bust, and so Silicon Valley might be doing better than others are in that sort of environment. But of course, the broader environment is, of course, as I just mentioned, right, we have this economic stimulus coming from some of the law. We also have a government shutdown. A government shutdown is often a lot of hoopla and very little comes out at the end. But it does mean very little is going to get done in terms of anything in Congress, probably, because there's also an election coming. And we got these brilliant choices. Everybody loves the candidates on both sides. The Wall Street Journal had a good article recently saying that it's unlikely for these tax cuts that are in part due for the significant deficits we have, in addition to, of course, all the additional spending, that they're going to be repealed, because the Democrats said they only want to tax incomes over 400,000. Well, much of the tax cuts went to people in the middle class and the lower income people. So there's not going to be dramatic changes on the tax side, but at the same time, this idea of having industrial policy is going to persist, which also means we're going to have sanctions and other things. As a reminder, President Biden did not repeal the sanctions against China and whatnot. And so they, on the foreign policy side, Biden and Trump, right, are not necessarily going to be all that different. We'll get more tweets or whatever if it's Mr. Trump, but on an economic side, it might not be all that different. Let me briefly touch on the international aspects.
I got one more question.
Okay.
Stagflation. So I think the Texas Federal Reserve Bank said that there was evidence of stagflation.
Well, Europe is clearly heading into stagflation because the European Central Bank is utterly behind. Currently, as of this morning, there's no more rate hike traced into the Eurozone. The US rate hike, we pushed it out to maybe in January. It was exactly 50% the odds for the Federal Reserve. I mean, stagflation, we define stagflation as a supply shock followed by a policy mistake. When you have a supply shock, which clearly both COVID was, and then there's these massive stimuli were, the stimulus is the mistake, because when you have too little supply of a good, energy for Europe, for example, or all the supply bottlenecks that we had in the US, the proper solution is not to give people money. When you have a check, it doesn't create more energy, it doesn't create more oil, right? And so that's why policymakers are very bad in dealing with supply shocks, because the economically right thing to do is often political suicide. Now, you can't say, oh yeah, we should slow down the economy because we don't have enough oil to fuel the economy. We actually launched a stagflation ETF in our shop because we think that a stagflationary period can last many years. It's not just a short-term thing that that's going to happen, and we'll see how this plays out, right? If you now think about the Federal Reserve being quote unquote higher for longer, there's still going to be some inflationary pressures, and again, it's because it's not linear, and so we'll have this industrial policy where we push certain sectors of the economy because the government knows better of where to allocate resources than the private sector. So all of that means it's a bit of a mess. I think that's the technical term. Now, to just take a little different perspective, historically there's a saying, the US can stomach a recession in Europe or China, but not in both places. Now Europe is clearly slowing down, and China is still growing by throwing money at its economy, but clearly has problems that are escalating, and they deal with it by arresting folks when they have a real estate crisis. That doesn't fix the real estate crisis. It might hold back some social unrest, which is, of course, the primary goal of the Chinese government. And then just the other thing, and this is maybe a little long term, there's still a war happening in Ukraine. when I look at the board, and two comments on that. One is, if you look at how Europe has rewired its energy supplies, it's quite astonishing. Clearly, the policies that much of Europe, notably also Germany, had were extremely counterproductive by shutting down nuclear while being ever more dependent on Russia. There are some interesting quirks. This morning, I think it was this morning or yesterday, was in the news that Germany is now exporting Russian liquid natural gas to India. And the reason is that they confiscated a former subsidiary of Gazprom that had contractual obligations. Russia is now supplying the LNG, and they have to supply the contract, secure the contract. So there's crazy stuff happening, but somehow the world will continue to function even with this craziness. But this war continues. The broader thing that I want to say is, to me, what's happening in Russia and Ukraine is more a symptom of an era to come. And what I mean with that is, being the global policeman for the US has got very expensive. The US is overstretched in its military. And I'm not suggesting there will be World War III tomorrow, but there will be more flare-ups. And the side effect of the US patrolling the global seas have been an amazing prosperity, because international trade has functioned very well. Well, when the seas are no longer safe, that also means an acceleration of the deglobalization that we have. And ultimately, it means that the goods will have going to be more expensive. There's going to be more inflationary pressures. And that's one of the reasons why I think these stagflationary pressures will persist, because you will have oddities and politicians don't like them. And so they'll throw subsidy one way or another. And that's going to create distortions one way or the other.
So I guess my question about Europe is that, all of these things have happened at the same time, and you would think that it would mean a long-term recession, at least, if not a depression. So it's not only has Ukraine happened and energy has been cut off to most of Europe for manufacturing, but all these Ukrainian refugees are flooding European countries, and straining their social systems to support, plus refugees from Africa, right? So you can't manufacture in Germany because they don't have any energy to manufacture. B, social systems are being tremendously, stressed, and yet, to me, the magnitude of that is nowhere in the news.
Well, they are discussing subsidies to the industry in Germany, right? They want everybody to be green, but then they're giving money to emit more fossil fuels in the industry. So they're trying to have it both ways. It's not uncommon for countries, once they start applying red tape everywhere, to try to square circles where you can't do that. By the way, talking about Germany, they're not counting the Ukrainian refugees. When they talk about refugees, they're only talking about the Middle Eastern ones. Those numbers are sufficiently high. And it's the bigger challenge is that I call it red tape, the rigidity is just preventing a reinvention. One of the beauty of the US is that we reinvent ourselves all the time and are much better able to adjust. Take the automotive industry, right? In the automotive industry, in the traditional automotive sector, when you have a display in the car, you order that 5 years before you go to market. Which means your Samsung tablet is from 2015 that you have in your wonderful Mercedes. Whereas a company like Tesla, and I'm not giving an investment recommendation here, is fully integrated, but they're thinking like a software company, and they're much better able to adjust to changing market conditions. And it's not that management has missed the boat, it's just that the unions are so strong. It is so difficult to change things. And yes, they will change things, and then they make some mistakes. And so if you have so much red tape, a very rigid system, and you have a world that's changing, it's very, very difficult to adjust. Now, at the same time, Europe is used to suffering. I don't think there's going to be a collapse. The other thing, of course, that's happening throughout the world, I mentioned the less stable geopolitics, is everybody has suddenly woken up that you need to spend on your military. Right? I mean, that's in the US, people realize, oh, we're giving all this stuff to Ukraine. Wait a second, our own supplies are low. The Europeans never had that much supply. They're realizing that they need to build up that stuff. And that's happening. And for the time being, everybody's applauding it. Now, the last time everybody in Europe was taking up arms, it didn't end so well. I'm not suggesting there's going to be any problem next year or two, but thinking 10, 20 years ahead or something like that with everybody in the world being in an arms race again. One thing is going to be expensive. And I didn't touch on climate change. People have many views on climate change, but I think the one thing most people agree on is expensive. It's expensive to deal with the consequences, but it's also expensive because policymakers think they know the solutions. And in my opinion, the market often has better solutions and also will make it more expensive in quote unquote fixing things. And so that's part of the reason why the stagflationary theme, when you have throttle growth and lots of government intervention is not.
So you talked about overstretched militaries, and obviously US is overstretched, but to me, there's some kind of a strategic analysis that's gone on in France where they have troops stationed all over Africa. There's revolutions happening in all these, African Franc, is that correct? Countries, right? These old colonies of France, and they're throwing France out, right? And France is to make a decision whether to try to stay and figure out a way to do a counter revolution or leave. And now it seems like most of France's decisions are to leave, right? So the engines of Europe are, France, Germany, and Italy, let's just say. I mean, most of Italy's industry has gone and sold to Asia, same thing with France. France doesn't have the African Franc maybe for much longer, if there's 7 countries that have already left. So, I mean, so it gets back to the whole thing of Europe and destiny.
The only thing I'd like to add to that is, think about Ukraine being the grain bowl of the world, right? They export a lot of grain to Africa. So if there is a food shortage in Germany, well, they'll get more expensive food and subsidize it. But if you have a food shortage in Africa because Ukraine can't export, you may have a revolution. And so that's what I talk about, is when there's less geopolitical stability. Now, when we invest in the S&P 500, we may not care that much when there is a revolution in a small African country. But some of these things, they will be cumulative. There will be more hotspots like that. There will be less stability like that. So let me just briefly touch on a few other items before I wrap it up. I would briefly touch on AI. You've got probably more than, well, not more than you want to, because I think you hear more about AI today. But I have actually a master's in computer science with a focus on artificial intelligence. Now, that was artificial intelligence 1991 and early 90s. AI has been around for a long time. If you look at the iPhone, they have talked for years on the neural engine to make Face ID work and all this stuff. The big change is that the public has woken up to the powers of AI, because suddenly speech works and you can communicate in proper sentences. I remember I worked in the early 90s on natural language interfaces, right? That technology has advanced a lot, but it's been a gradual move. And so right now, every project, once you get financing, has an AI component to it. I do think that AI has a very important role to play, and it's going to be very beneficial to Silicon Valley, but it's not a new thing. What's new is that there is a lot of attention to it, and there's a lot of hype, which also will get some projects to be potentially be a bit overvalued. And you see that, of course, in the stock market, in the big dispersion, that some companies that use the AI tagline have much higher valuations. It's going to be in the theme of the boom and bust period. But similarly, it's not the end of the world in terms of something, because suddenly you can be fooled more easily. This is all gradual in that sense, right? It's just people are realizing that some of these issues are there, but it's not like there is something that's dramatically different. So let me, just before I wrap it up, briefly just tell people what I do. I mentioned we manage a little over $1 billion in gold mining. Gold sector is interesting because it's very sensitive to interest rates. The gold miners are interesting because the small ones need notoriously often funding. They really need a bad economy, because then the funding goes to that segment. One area we've gotten involved in is strategic minerals. So on the gold mining side, we fund some of these exploration projects. On the strategic mineral side, we will be funding a lot of those projects. If anybody's interested in learning more about that, reach out to me. On the private side, outside of our formal business, I mentioned we bought a multifamily home there. I've mentioned some of these things to Marty. We bought some forest in Finland. My wife is from Finland, so that's the affinity.
Oh, yeah.
But that's a way to diversify. That forest tends to be healthy. has all the green labels, certifications that suppliers want, with supply out of Russia not coming and not being good quality. There's a lot of problems with quality elsewhere. And so we do several different, we also have a little vineyard as a hobby. That's not exactly to maximize profits though. But there are things one can do to try to diversify an environment if one doesn't think that the S&P is always going to go up. Note that on these projects I mentioned, we haven't taken on any debt. And I think that's a relevant component because it takes away the pressure. If you believe the recession is going to be more severe, you want to be careful. And I'm not saying people can't take any debt, but you want to be careful because that is what obviously gets to bite you in a downturn. Anyway, I'll wrap it up here.
Questions from the audience?
I just got one quick question. You know, there's a lot of corruption in Ukraine, but nobody talks about it except for Vivek and RFK Jr. But two things of note. Number one, Chuck Schumer and the Republican, minority leader, I don't even want to name it public because hope it gets replaced soon. But they have agreed that notwithstanding the shutdown, they're going to guarantee the aid goes to the Ukraine, number one. But then another thing from last week, the United States is going to give $30 billion to the World Bank. And the World Bank is going to give that $30 billion to the Clinton Foundation to rebuild the Ukraine. Now, think of that. Is that not blatant corruption? In terms of the fact that this country is getting I don't think I'd have the courage as a president to do that.
Is the
So
question?
it seems like there's a problem there.
I think there's a question somewhere there.
Yeah, so there's a question, but how does this end? Is it continue on because this money keeps flowing and stuff, or how does the war end? Do you think you see the war?
To try to stay on topic, the only comment I'll make is I don't think it's going to impact the GDP next year.
Yeah,
Thank you. I agree.
okay, but I mean, are we gonna still be fighting in that war 2 years from now, or 3
Well,
years?
as I indicated, I think it's just a symptom of the direction the world is heading in. Anyway,
Okay.
Question. Thank you so much. This was really interesting to hear. You mainly invest in natural resources, minerals, forests. What are your thoughts on healthcare? Because, as we're aging as a population across all countries, we need better healthcare. We need to live longer, healthier, happier as well. Where do you see healthcare as an investment strategy? Downturn, upturn, doesn't matter.
Actually, let me rephrase that. Your wife is super active in ESG, right? And healthcare is part of, social, it's an environment too, right? And
well,
what are your thoughts?
I mean, I'll only answer to the extent that it's my expertise, which means I'm not going to give you a full answer because the others are more qualified to give you an answer than I can. The one thing that I can say within my expertise, actually, the funding is very similar to many startup healthcare projects as in the mining side, because they need notoriously often funding. They often go public early, go public markets early. So there is similarity there. Doesn't answer your question. There is a huge shortage of workers in healthcare. And since we just talked politics, one political pitch I'll make is we are encouraging men to be more in STEM jobs. We definitely need to encourage more women to be in STEM jobs. We need to encourage more men to be in health jobs. If you can be a nurse rather than a truck driver if those jobs go away, and I think that's one way we can save that divide. Beyond that, I'm not the expert. I see what everybody else is seeing. I do think yes, definitely there needs to be a lot of investment. Healthcare, like many industries, is one of those super regulated industries that's holding back the industry. The one thing I see in my segment of the market, I didn't touch on crypto today, but the regulations, the lack of good regulations can really hold back an industry. And then you have a lot of techies involved in some of these fields that don't understand the regulation, and it's a real pity. And so, but that means that these markets need to mature. I know I don't fully answer your question, but it's mostly because I leave it up to others who know that industry better than I do.
Thank you, but you touched on a few good points. Thanks.
I actually have a question about funding. That's later, but let's talk about what the audience is asking. So a couple of questions. Are you interested in lithium or vanadium mines at this point in time? Okay. how do you learn about mineral investing? Like, what do you, is there like a fast track course to take, or, like, is there a good book to read, or?
It's a fair question, and it's one reason why I encourage people to reach out to us. It's one of these, anybody can dig a hole in the ground, right? But just like in any other industry, it is very select management teams that have a track record of actually being able to take care of that. ESG came up, right? Well, the mining industry has been into ESG way before it became a hot topic, because you're not going to get a reputable mine authorized unless you take care of the local community, unless you have an after mine life plan, and all kinds of things, right? Obviously, the media highlights things when things go wrong in some places, and not all jurisdictions are good, but it is a few management teams around the globe that are good at these sort of things, and a lot of that is experience. We have relationships with many of those and have helped fund projects over the years, mostly on the precious metal side. Now we'll do it more on the strategic mineral side as well. And you need to get to know the local jurisdiction. You need to know what sort of mining is appropriate for this particular mineral at this particular location and whatnot. So by all means, you can start reading up on it, but it does take takes teams and a lifetime to build that. I have a team that does that for me. I'm quote unquote just the chief investment officer, but I help facilitate that through the team that I work.
I just have one comment to make about AI, and then we've got a whole bunch of questions from speakers also. But my comment about AI is that computer technology is mostly extractive. I don't think it really, like, you get on video and then like every 30 seconds it asks you to watch an ad or to donate $1 or 50 cents or something, right? I mean, that's extractive. I don't think it helps your quality of life. When AI starts building better roads, or watches farmland better or things like that, that's great. If it helps drones detect where there's problems with insects eating up farms, perfect. But for the most part, just because you have more AI doesn't plug potholes. I mean, right? Does that make any sense? I mean, just from what's the quality of life value of any of this stuff, right?
Well, what is AI? Maybe that's a good question, because that's a buzzword, and people think that creating a gray box or black box that spits out a good answer is AI, and that's certainly a practical application. There is a not so young anymore professor, Judea Pearl. He was hip on AI, wrote a book on probabilistic reasoning in the late 80s. He recently wrote a book on causation, and his argument is it is not intelligent unless it can do proper causation, like cause and effect, and distill that. And if you think about, you probably can relate to when the tobacco industry got sued. It was finally there were some arguments made as to why you can show that tobacco is harmful for you. It's taken for granted by many people today, but for decades the tobacco industry was arguing differently. And the argument that he makes is that we don't fully embrace the language of AI, of what it means that A causes B. Right? We talk about correlation in the financial markets all the time, and then we give the disclaimer: correlation is no causation. Well, that's fine, but it's not good enough, right? There is actually a science of causation, and in my view, the current theme of AI is that we can interact more naturally with it, and that's cute. But the next phase is going to be causation, and that's still a few years away. And so there is always something that we can do even better and greater. The nice thing is that we have a lot of bright kids, if I even call them, that we're focusing on digital assets now, getting involved in this. And I'm not saying digital assets don't have some promise in certain areas, but you need bright minds pursuing these things, and I think good things will come from that.
Good. Tyson, did you have a couple of questions?
Yeah, I do. There's an idea out there called the commodity super cycle. And my general observation of the markets is we've had abnormally low interest rates, stocks, bonds, and real estate way overvalued. Commodities have gone nowhere. Where do you see the precious metals and strategic minerals going over the next decade? Do you have any view on that?
Well, the first thing is I mentioned the Federal Reserve is haunted by the 1970s experience. In the 1970s, of course, the world is a little different, but equity prices in real terms had a lousy performance, and Oil was doing very well. Real estate was doing very well. Gold was doing very well. And so there is an argument to be made that in a commodity super cycle that some of the same sort of things will do well. Now that said, many of these commodities are notoriously volatile. And especially when isn't engaged in that space, one tends to underestimate the volatility that can happen. These prices can really plunge or soar, right? And there's the saying that the markets can stay irrational longer than you can stay solvent. So just because you have a positive view doesn't mean the market will go up every day. And I just like to throw that out as a uranium is hit right now, right? But that doesn't, and obviously uranium is what you need to solve climate change because you need to build more nuclear power plants. But it doesn't mean uranium prices will go up every day, right? And many of these metals, it's not easy to get exposure to them. And by the way, since we're talking about that, the difference between the metal and the mining is the metal is kind of a pure play. It's not always as easy to get exposure to it. The mining tends to be a levered bet on it. So you take a bet on something that's already volatile, especially on the junior side. You're literally buying an option on them striking gold or finding things and being successful. And then as they get funding for the next phase, and that's, by the way, one reason why you want to deal with somebody who has the connections, because when you get involved in the funding, you tend to get things at a discount. And unlike the typical illusion that the eBay or some valuations, you can get the startup valuations because you got the funding for the next phase. If you have the large producers at the other end, and by the way, the oil companies is getting into the mining of some of those strategic minerals, it's of course different, right? Then you don't have less of that. And currently, a lot of the mining companies, at least, they have underinvested in resources because the investors have told them to get their act together after the 2010s when they splurged too much. And so there are these cross currents that don't make it as trivial and saying, yeah, the commodity price is going to go up. I put all my money there.
Corey, did you have a question?
No,
Evelyn?
No, I already asked about the lead, so I might be in touch with you about the vanadium mine, okay?
Fantastic. And most, my only, what is the stagflation ETF? What are the components of that?
Oh, yeah, I don't want to pitch our own products. It's an ETF we launched a year and a half ago, which literally invests in gold, oil, real estate, and TIPS invests as well in. TIPS, inflation-protected securities. Yep. The idea is that when you buy TIPS, it's one of the most misunderstood securities out there. When you buy TIPS, you're locking in real yield. The TIPS, inflation-protected securities, they're just based on inflation. And of course, you can argue, is the CPI the best way of addressing inflation? But what it does is you're locking in the real yield as priced in. And so when you have a hawkish Federal Reserve, real yields tend to go up. We were at 222 on the 10-year yield, real yield. And by the way, the reason this matters, for those who are skeptical about long-term inflation expectations, is markets are pricing things off of those sort of references. And one thing I didn't mention, as inflation comes down, the Federal Reserve will probably say, when we cut rates, it's not really easing. We just don't want real interest rates to go up too much. And so they will sell an interest rate cut as actually not being dovish. But if you think that the Federal Reserve is past peak hawkishness, then inflation-protected securities might be something that's a decent place to invest in, because as the Fed is getting more dovish, then there will be a potential disproportionate gain in these. And because they had been dovish, that speculation ETF actually performance hadn't been so great. Every day, take a day like today where oil prices up, it's doing well. So it really depends on what the outlook is, where things are going to go going forward. But it's an ETF, it's a tool.
Any other questions? I've got time for one more. Parting thoughts, your final statement about the outlook for the next 6 to 12 months. You think it's going to be volatile, or it's going to be kind of like steady stagflation?
I think it's volatile.
Cost of everything.
It's volatile because both monetary policy doesn't have a strategic angle to it, and the other one is, of course, valuations are high. That also increases volatility. And then one thing I'm sometimes asked, what's your investment advice? And of course, I can't give that, except that one thing I say is people underestimate the investment in health. And I don't necessarily mean health stocks, but you can control your own health. You're an income generating machine. And so if you invest in your own health, it's probably one of the better investments that you can make.
I agree on that one. Yes. Well, thank you so much, Axel. This is really great.